Okay. Okay. First of all, let me thank the organizers, including our paper, and thank you for the opportunity for us to present this paper today. This is a joint work with my co-author at the Bank of Canada, Mohammed, and the usual disclaimer applies. As we know, right, many central banks are considering the issuance of a central bank digital currency, which is basically a digital form of central bank money that are widely accessible, right? According to a recent BIS survey, right, the number of central banks that are, engaging in CBDC work has been increasing and has recently, right, reached 90% of the survey respondents. And most of the work of this CBDC work, right, involved issuance of retail CBDC. And as we have learned, right, from Rod Garrett's Money Flower with his co-author Morton Beck, that retail CBDC is basically covering, right, that shaded area, right, that retail CBDC is different from cash, right, because it is digital, and it is different from bank deposit, right, because it's issued by a central bank. And in terms of design, it could potentially, right, be account-based, like bank deposit, and it can also be token-based, right, like cash. But independent of design, right, a major concern, I would say, for central bank about the issuance of CBDC is about potential impact on bank intermediation. What does it mean? That if CBDC is designed as a close substitute for bank deposit, then it may raise the bank's funding costs and as a result lead to disintermediation, right? And such a concern, right, for example, is raised by a BIS report in 2018 that the issuance of CBDC could lead to loss of low-cost and stable funding for banks. So in terms of academic research, right, this question has been studied, right? For example, one kind of important paper is by Chiu and Sanchez, forthcoming at the Ristead, which finds that, right, issuing an interest-bearing CBDC can disintermediate banks, right, when banks are perfectly competitive. This result can change, right, when banks have market power. For example, the work by David and Delfado, and also my earlier work with my co-authors, right, find that right, when banks have market power, right, this intermediation may not happen. But still, so far the key understanding is that CBDC will disintermediate banks, right, in a competitive environment. And this is exactly that conclusion that we want to revisit in this paper. In particular, right, so we want to focus, right, so abstract from the market power channel and focus on a competitive setting and ask the following question. Does the CBDC necessarily disintermediate banks, right? And how does the answer depend on the CBDC design? So that's what we want to study. And to answer this question in particular, we want to, based on kind of the Chiu and Sanchez model as a benchmark and make minimum deviation from their model. And but we make two important changes, right? First is that we're kind of considering kind of a realistic consideration that cash and deposit compete directly, right, in many transactions. In the US, for example, according to payment survey, over 70% of the transactions accept both cash and deposit as a payment instrument. So in that sense, they're competing as potential payment options. And the second important component for this study is that banks help to finance the production of consumption goods that are traded in the retail market, right? As we know that many manufacturing and retail firms rely on bank funding as bank loans as the main source of funding. So these are two kind of the main deviation from the Chiu and Sanchez model, and we find that we get very different results. We find that CBDC can crowd in bank intermediation, even in a competitive environment. And we find that a cash-like design, which I will define later, is going to be more effective than a deposit-like design in terms of improving intermediation, consumption, and welfare. Okay. So before I show you the model and the result, let me mention that this is, as you know, right, this is a young but fast-growing literature, right? Many of you here have contributed to the literature, exploring the implications of CBDC for banking, financial stability, currency competition, monetary policy, and design of digital currency. Right? Probably I have missed some citation here, but of course our papers, closely related, in particular to the first line of research. Okay. Now, I won't have time to go through all the details in the paper, but I want to show you a simplified version of it, highlight the key forces, and why we get the result. Okay, as I mentioned, we try to stay as close as the Kister and Sanchez paper as possible, and which is based on the Lagos-Wright setting. If you're familiar with the Lagos-Wright model, right, basically it's the infinite horizon model, and then in each period, there are two sub-periods, right? There is a decentralized market in the day and followed by a centralized market in the night. In the decentralized market, search frictions and information friction give rise to the use of different payment instruments, right, to finance transactions. And then in the centralized market, agents can rebalance the portfolio of these different payment balances. But let me mention that in our model, right, in terms of our result, search frictions are not important, right? So you can reproduce all the result in a cash advance model, for example. So in a sense, our result is kind of robust to the model set up. And in our model, we have three types of agents, right? We have households, we have firms and banks. Household, basically they work, right, supply labor to firms, and they also purchase goods in this decentralized market using different types of payment instrument, which I will talk about on the next slide. We have firms hire labor, right, to produce consumption goods that are sold to households in a competitive market. And then, but firms do not have any resources, so firms need to borrow the funding from banks. Banks lend, right, to firms to finance the projects by creating deposits, and at the same time, these deposit balances will be used by households as one of the payment instruments, right? So these are the main actors in the model. Okay, as I mentioned, a key component of the model is this different payment instrument that are used in the decentralized market. In our model, we have three types of meetings. We call it type 1, type 2, and type 3. Type 1 are those meetings where you can only use cash. Right? Think about an offline setting, right, where you cannot use your credit card or debit card. Right? So in the data, about 15%, right, of the transaction in the U.S. belong to this category. A second type, the type 2 transactions are those that you cannot use cash, right? Think about online transactions, right? Cash is not viable. The data around 13%, and the remaining 72% belong to the third category, right? Most of the typical point of sale situation, right, where you can use both cash and deposit, meaning debit card or credit card, right? So we have these three types of meetings. And then, in that sense, the model is kind of related, right, to the Lucas-Tukey model where you have cash good and credit good. In the simplified version today, we won't show you the credit, but in a more generalized version, we also provide credit to agents for use in the type 2 and type 3 meetings. But this is not so crucial for the result. It's more for useful when we match the data in a quantitative exercise. Okay, So this is the economy without CBDC. When we introduce CBDC, we'll talk about, well, different types, right? Potentially a CBDC could be, you know, cash-like, that it can be used in a type 1 and type 3 meeting, right? Think about like a prepaid card or a store value card, right? That you can use offline. You can use it, you know, point of sale, but you can not use it online. And then that can be deposit like CBDC, kind of maybe a debit card like system, right? That you cannot use it offline, but then you can use it in other meetings. Right, so in that sense, you can see that a cash-like CBDC is kind of special, right? Because unlike deposit, right, it can be used in type 1 transactions, and unlike cash, it can be interest-bearing potentially. Okay, so let me tell you a little bit household decision in the decentralized market. Basically, think of a consumer who brings a portfolio into the decentralized market, a portfolio of cash denoted by Z and deposit denoted by D. So when you're there, right, so you may or may not want to consume, captured by this parameter sigma. And then if you want to consume, you want to decide how much, right, to consume for good 1, 2, or 3, C1, C2, C3, which may have, you know, come with a different utility function, U1, U2, and U3. And then your decision is subject to 2 constraints, kind of liquidity constraints. The first one is associated with cash, right? Because cash can be used in type 1 transactions, C1, and also type 3, a fraction of type 3 consumption, right? You can choose the fraction F of type 3 transactions that are financed by cash. The remaining will be financed by deposit, right? Deposit used for a type 2 transaction and type 3 transactions. Okay, where W is just the continuation value in the following centralized market. Okay. And I mentioned about, yes?
So I noticed you do impose price uniformity. There's no discriminating.
Right. So this is the simple version of the model. We did have an extension where basically you produce an intermediate good, and then the producer can decide to turn it into a final good in different market, where the final goods can be sold right at the different equilibrium prices.
I mean, the price doesn't depend on the method of payment. There's no.
That's true. That's true. Yeah. So we make that assumption, and I need to think about whether or not. So this is competitive pricing, right? Kind of the merchants take that price parametrically. Now, maybe you're thinking if the merchants can price discriminate. I need to think about how to incorporate that into this competitive setup. But that's a good point. So this is competitive, right? So price agents take price as parametrically. I mentioned about we can add credit, and how we did it is basically, okay, you can use credit, but subject to a borrowing constraint B. So that's how we introduce credit later. Okay, and firm, right? The kind of we borrow also follow kind of Kister-Sanchez, this simple setup, but we moved a financial friction in their model, right? So basically, firms, they have a project, right, that gives you they can produce using a production function, capital F, but they don't have funding, so they need to borrow from banks, right? They take as given, right, that the price of the goods, P, and also the interest rate, the loan rate. So they solve this problem by choosing the scale of their production, K. In equilibrium, of course, they equate the marginal revenue product to the interest rate of the loan, which in equilibrium will also be equal to the deposit rate because banks are competitive, right? So loan rate will be equal to the deposit rate.
So
yes?
So now I'm a bit puzzled. So this happens during the centralized market when they borrow the capital?
Yes.
And so when they go into the decentralized market, the amount of production is already fixed. Is that right?
Right. So exactly.
So I mean, it's not. I mean, often in these Lagos Right model, there's on-spot production, but that's not what you have here, right?
And this is important, right? So let me just clarify it again, right? So firms, they in the centralized market, right? They need to decide how much to invest to produce, the hire labor to produce, and then they will sell these goods, right? In the following decentralized market. And since it's a stationary model, right, and it's competitive market, they know the exact price. There's no hold-up problem, right? So basically, they just, yeah.
And maybe that's sort of back to David's question. Normally, there's a bargaining, decentralized bargaining. One side has bargaining power and this on-spot production.
Right, exactly. So that may matter, right? If it's bargaining, right, and if you have the goods produced already, you will be subject to hold-up problem, right? This is not a problem because this is competitive, right? So this problem will not show up. But this is, we will kind of generate the same result as Kister and Sanchez.
Three centralized markets and the decentralized market.
Three. So here is basically you hire labor in the centralized market for your production, right? And when you produce the goods, you will go to the decentralized market, kind of the day market, to sell your goods. And there are segmented this.
No, what I'm trying to say, I guess this is probably the same question. Your decentralized markets are not decentralized in the sense of Lagos and Right. These are not bilateral meetings. We have to think about, what is a bargaining protocol and so forth. These are very centralized markets, right? There's a centralized market for cash only, a centralized market for deposit only, and a centralized market for borrowers, and consumers kind of randomly arrive at each. And maybe firms, I don't know, that maybe there's location decision for firms, but then these are huge markets, and the only thing that you can't do is trade financial instruments and capital. That's probably the way to think about it.
Exactly. Thanks for the clarification. So in the day market, there are three parallel centralized market, right? Borrowers still use the label of DM, right, because of Lagos and Right, kind of confusing, right? So this is correct. And then there's a goods market clearing condition. Okay, so these are all the components, right? Okay, and let me summarize the key, the overview of the model again, to highlight the key components. So to produce, firms need to hire labor, right? And then firms need to fund their production, borrowing from banks. Households buy the goods in the goods market, right? Type 1, use cash. Type 2, use deposit. And type 3, using both. Okay, so it's very simple setup. Let me highlight two key differences from the existing models, such as Kister and Sanchez. One is the presence of these type 3 transactions, where you can use both deposit and cash. This is important because cash and deposit will compete directly. What does it mean? It means that if the central bank issue is cash-like CBDC and pay interest, you are going to exert a competitive pressure on banks and force banks to raise the interest paid on deposit in order to retain their depositors, right? So this competition channel is missing in the Kister-Sanchez model. A second very important component is this feedback loop, right? From the goods market back to deposit creation. What does it mean? It means that if there's a higher demand in the goods market for whatever reason, it will induce firms to borrow more loans from banks, and then banks will have incentive to create more deposit, and that ultimately will be used by households. This feedback loop is missing in the Kister-Sanchez model or many other Lagos Right-based model.
John, can you say that
again? Yes. So firms, right, when they sell the goods, it's sold to the goods market. If the demand for goods is higher, firms, when they produce, they need to acquire more loans to finance those production, right? And banks, when the banks lend, they lend by creating deposit. So the more deposit will be created, right? this channel is missing in Lagos-Wright. Why? In the Lagos-Wright model, those goods that are produced by firms funded by loan will be sold in the CM, not the DM. In the CM, deposit is not used for transactions. So this channel is missing. This feedback loop is missing. And this is important for our result because the model is closing the loop, right? In the sense that we are connecting the loan and the deposit, right? The liability and asset side of the banks in the goods market, right? Banks, on the one hand, create loans to finance production. Those production will be traded in the goods market. Households use deposit as one of the payment instruments, and the payment instruments are the deposit, right, created by banks. So that it means that, say, if the central bank, paying higher interest on CBDC, that will force banks to raise the interest rate, right, pay on deposit. In the Kister-centrist model, there will be a funding cost channel, right? So the cost of funding goes up, cost of supplying funding goes up. In this model, there's additional force, right? That when you pay higher interest on deposit, you will induce higher demand, right? That and banks and then firms need to borrow more loans, and that will generate a higher demand for loans. So that's not only a supply side effect, but also a demand side effect, right, in the funding market. This effect is missing in the Kister and Sanchez model, and that is important for the result. I hope that this is clear that these two distinct features of the model. Yes. Ultimately, they pass on, right, to the firms, right? Because firms, right, they reduce the loan, and then there's, diminishing return, right? Okay, so I have 5 minutes. Let me summarize the key result, right? So when the result is that when CBDC and deposit are both used, right, in some transactions, the type 3 transactions, in the 7% of transactions, we find that a CBDC, cash-like CBDC, can crowd in banking, right? Promote consumption, investment, and welfare. And this effect is stronger for deposit-like CBDC, right? So let me tell you why, the intuition. The intuition is that we know what's the wrong with using cash, right, in this type of monetary economy is that cash is non-interest bearing, so that people want to economize on the consumption and lead to inefficiency. Now, when you introduce a cash-like CBDC, which is interest bearing, you can lower the opportunity cost, right? So agents would like to consume more, of course, right, in the type 1 and type 3 transaction, those transactions that are cash-related. But the effect will not stop there because cash also compete with deposit, right, in the type 3 transactions. So that will induce banks to pay higher deposit rate, right? So that there will be spillover even to non-cash transactions, the type 2 transactions. So that's why there is direct effect and spillover effect, right? And this competition channel generates this spillover effect. And then when there are higher demand for goods, the feedback channel kicks in. Higher demand, right? And then firms need to demand for more loans. Those loans ultimately generate demand for deposit, right? That will increase intermediation. That's the second channel that's missing in the existing model. And then there is the Kister-Sanchez channel, right? That when you have high interest rate, increase the funding cost. This is a negative channel. Overall, we show that the positive channel will dominate, right? That generate a higher consumption, banking, and welfare for cash-like CBDC. For deposit-like CBDC, we show that the effect will be weaker. Why? Well, this is the logic goes the same, right? You have a deposit-like CBDC interest-bearing, you reduce the opportunity cost, right, of holding balances, so there are more consumption in type 2 and type 3 transaction, but there is no spillover effect to type 1. Why? Well, because cash is non-interest-bearing, right? The interest rate on cash will not respond endogenously to this competition. right? So that this spillover effect is missing. As a result, the effect will be weaker. Okay? So if you understand that, this is basically the key message of the paper. And then we did some quantitative exercise to calibrate, the time series of money demand, to calibrate to the cross-sectional, payment survey data, in particular, what fraction of transaction for different types of trade. And then we did some quantitative exercise. So this one is for cash-like CBDC, right? And then we look at the maximum possible impact, which is the case when you pay a 5% interest rate on cash-like CBDC, which is basically like running a Friedman rule. What will be the impact on, consumptions and aggregate consumption, right? And then we decompose into the 3 channels. The first one is the funding cost channel, the one captured by Kister-Sanchez. The second one is the payment efficiency channel that, right, you reduce opportunity cost. As a result, right, that you get higher consumption in C1 and C3, but then there's spillover to consumption 2 too. So note that we have exactly the same numbers because in this example, we have separable utility and the same utility function. In general, the numbers can be different. And then on top of that, we also have a price channel. What is it? Because the production is subject to diminishing return, right? So when demand goes up, marginal costs will also go up, right? So that will mitigate the increase in output. But overall, right, a cash-like CBDC will raise consumption and crowd in banking. Again, a deposit-like CBDC will also have this channel. The only thing that's missing is that there will be no spillover effect to the type 1 consumption. As a result, the effect will be weaker. Okay, so these are the main results I want to present. And to conclude, so in this paper, we kind of study a very simple setup, right? We try to stick to the Kister-Sanchez setup, make minimal changes. So we ignore many other reasons to issue a CBDC, like privacy, safety, resilience, for example. But we show that, right, CBDC can still improve welfare and crowd in banking, even when banks have no market power. And what is important here is to read the GE feedback loop, which is missing in the standard model. We also showed that, right, a CBDC, cash-like CBDC could be more effective in generating, this result. And if this is really desirable for central bank, right, to realize that, 2 things need to be done in terms of design, right? The CBDC need to serve the current segment served by cash, which is when cash is the only option, like offline occasion, and when cash compete with deposit, like point of sale, and cash need to bear interest or other perks that can compensate for the opportunity cost of holding it. Okay, so thank you.
Hey, Jonathan. Yeah, great paper. So what's driving it is the inefficiency of cash, I guess. And this causes consumption to be too low for the usual reasons. We'd like to approach a Friedman rule-like solution. One way to do this is an interest-bearing token that competes with cash. So banks actually end up better off because they get to intermediate, they do more business. Well, I mean, they get 0 profits. This is it doesn't disintermediate banking. It may actually expand their deposit base and expand. Okay. There's nothing to prevent the banks themselves from issuing this product, I guess. There's nothing critical that makes this a CBDC necessarily. If we were to permit the banks themselves to issue these token-based liabilities, I presume your analysis goes through, or is there something critical that makes this have to run through the central bank?
So are you thinking of an interest-bearing token privately issued?
You know, in the old days, banks used to issue banknotes.
Right. So so it has to be interest-bearing.
No, I mean, I'm sorry, 0 interest-bearing banknotes.
0 interest-bearing banknote. Is it backed by something? Or so here, implicitly, we assume kind of the banks issuing liability have to be backed by the projects.
Well, these tokens can be backed by the project. In the old days, banks used to issue, bearer instruments called banknotes. That's these are the digital analogs I'm thinking about here, except that here they could be interest bearing.
Right. So the kind of as you mentioned, right, the key inefficiency here is the non-interest bearing cash, right? And we know one in the Friedman rule to solve the problem. There are two ways to do it. One is the deflation, which is maybe not desirable because central bank want to target a positive inflation rate. Another way is to pay interest on cash, which is not feasible exactly because cash is non-interest bearing. And the CBDC is solving that problem. So now if the commercial banks or some entity issue token, if it's non-interest bearing, it won't help, right? If it's interest bearing, then we need to think about how to finance it, I guess. Right, so, right, so I suppose that, I think maybe we can talk more. One of the your paper, right, or number of papers, basically you can sell it, incorporating goods, and then use those capital, and use those capital to retire the cash over time, the tokens over time, and generate, maybe it could be done, but I need to think a little bit about that. Yes.
Yeah, I'd like to follow up on the Friedman rule question, right? And at the same starting point as David here. So in the background, there must be a real rate and an inflation rate, and as you pointed out, right, there's then a nominal interest rate on, forget about deposits. Imagine we just have a CBDC here on which we can pay a nominal interest rate. There's a nominal interest rate on the CBDC that would eliminate the cost of holding CBDC, which is, I guess, such that CBDC has the same real return as any other asset. Right. But once you go on so if you go there with a nominal interest rate, that will be that must be the welfare maximizing point. If you go beyond that, then welfare must be decreasing again, right?
Maybe not even feasible because people, I don't know, in this setup, usually in Lagos, right? People,
maybe these are two different goods, right? The day good, right, and the night goods. So, maybe it's feasible, maybe it's not. I don't know. Right. But is that what's driving the welfare result really?
Exactly. Exactly. This is the same inefficiency.
So you're just going close to Friedman rule, but
right,
or maybe exactly at the Friedman rule, but not beyond. Is that
right? Right. Exactly. It's just that you cannot implement it without deflation, right? In a cash economy. Now, cash like CBDC can be interest bearing, overcome that friction. It's a very simple point, indeed. Any other questions?
Yeah, so one comment, Jonathan, is in all these presentations, right? I think we are reinventing the way central bankers done on the CBDC. And to me, that's a problem. Why can't we start with something that works only digital? I get it, central banks have a role to make sure if there is one guy that wants to pay by cash, we have to take care of him. I get that. But aren't we trying to take the first principles in which money is designed and putting it on the CBDC? When 1,000 cryptos are there for a different reason, right? So when we say we need the CBDC, it is to have a digital alternative. My worry is we are taking monetary policy, price stability, perfect competition, all kinds of 300-year-old stuff, 500-year-old stuff, and putting it on the CBDC. And it's not on you, I'm just saying, in the thinking. So, but I also get it that you have to do it that way, but there must be a better way, right? Because at this rate, I don't see anybody launching anything in the next 10 years, to be all honest, right?
Right, so I think there are maybe two components of the question. The first one is about the implementation, right? Do you need to reinvent a new technology to issue a CBDC, or can you use existing technology? Can blockchain,
new
for example,
digital terminology and a new law.
So in our setting, if you want something like offline, maybe crypto is harder. Maybe it's feasible, I don't know.
We shouldn't do offline cryptos.
Right. So
we should not do offline cryptos. Why we don't do offline cards? That's like a dying breed, right? We should create a new law which makes it easy on people, saying that these characteristics of people will only be eligible for a CBDC. We are not trying to solve like 10 guys live in a forest because of their lifestyle choices. We can't wait to launch a CBDC because of those guys. And I get it. We need to have an answer, but my personal view, and look, I don't have a PhD, so I apologize. So, as a practitioner's
let me mention that in Canada, that's a big issue. We have a big country, right? In many part of the country, there's no internet connection. And so this is, even though there may be a small segment, this is something that maybe a social planner want to take care of. So this is the first component, right? What technology option out there is the blockchain a feasible option. The second component is that, like related to David's question, if you allow the market to solve it, can private agent have incentive to do so, right? So that, I don't know. So we don't have much to say in this paper, but that's a valid question.
Okay, so maybe we have to take a break. We're already late. So
Thank you, everyone.